Hello and welcome to BQ Prime. This is a special interaction that we are having on the derivatives market. And joining me is Mr. Ashish Gupta, CIO Access Mutual Fund. Ashish, thank you very much for joining us on BQ Prime. As you said, nearly 99.6% of the volumes today account for derivatives. That's totaling roughly $4.3 trillion a day. What we are seeing is that the odds of derivatives are much worse than fantasies for games, and that's also creates a worry for the market because of the kind of risk that comes in on the investors. Ashish, to begin with, uh, do you think that the entire the way the shorter options have been put into place, it increases not only the risk but also the market systemic, it brings in a systemic risk at some point in time?
Sure. Hi, thank you for having me. I think it is a very notable and interesting development that has come about in the last just few months, right? As we have seen introductions of weekly options and then more recently daily expiry options, and that availability has gone up the volume in the derivatives market. And in fact, really, we don't even need to use the word derivative, just the option market has exploded. And it has not only increased, but it has increased in a manner which is disconnected with the cash market, right? And that is rather than just the volume of the option market, what kind of is notable is that it's disconnect with the underlying market, and no, which is what I've highlighted in my report, that it is 400 times that of the cash market. And really, even globally, we see no instance where this market is more than 3 to 5 times that of the cash market. And as we highlight in the note, we find most of this activity is speculative in nature. These options are held for very, very short periods of time, roughly on an average by retail traders by just about 30 minutes. There are high frequency algo traders whose average holding period is just 3 to 5 seconds. And the open question is, what does it mean as a risk to the broader market, right? And unfortunately, we don't have any empirical evidence to suggest how it is affecting the underlying market. But my belief is that if the option market is so outsized compared to the underlying market, unfortunately, if there is any spike in volatility in this market, it will start to have a major impact on the underlying market itself. Right? So options or derivatives, as you know, are contracts that derive value from an underlying equity. So the option market should actually take a cue from the underlying equity markets, but here the relationship could turn on its head.
That's what, isn't that what is happening? Because we started derivatives with the purpose of hedging risk, but now derivatives is become a tool for taking risk. And today, because we have an expiry every day, one index or the other, whether it's Fin Nifty or Bank Nifty or a Sensex or a Nifty for that matter, the kind of action that we see in the cash market, so that the expiry can happen in the derivative market, is influencing how the stocks are playing out, right? Means it's not the underlying which is determining the closing or the settlement of the price. It's the kind of movement that happens in the cash market for stocks that's now or that's now been made. It's getting manipulated to suit the settlement in a derivative market.
So I'm not too sure of that, already the cash market is being dictated by the derivative market. If we look at the derivative market volume today, it is primarily constituted by index options, right? When the F&O market got introduced in India, initially we saw volume primarily build up in futures market, including stock futures, right? But in case of options, primarily the volumes are residing only in the index options market. And because the growth has been so disconnected with the cash market, even just 6 months ago, derivatives market volume was only 200 times that of the cash market, and today it is 400 times. We haven't really seen the cash market getting impacted. So we haven't actually seen any spike in volatility in the cash market over this period. So as of now, while we haven't seen the option market dictating the cash market, but I believe the risk is that if there is any major fallout or if there is any a spike in volatility in that market, potentially it can start impacting the cash market as well.
Because we have seen certain instances like on a Nifty Bank expiry or a Fin Nifty expiry,
Yes.
a movement in a few stocks which has a higher weightage
Sure.
can
Sure.
can take your options positions to what you
Yes.
want to desire, what you desire at the end
Sure.
of the day. So we have seen that kind of movements happening there, right?
And, certainly, on particular trading days, we see that volatility around the expiry day, but at least it hasn't reached a state where there's a dislocation in the underlying stock prices itself, right? So you might see for a short period of time on that day, the stock spiking a few percentage points or correcting a few percentage because of expiry, but at least there is no sustained uptrend or downtrend because of the derivatives market. If you recall, globally we have seen in financial markets, particularly when the entire CDS market blew up, it impacted the underlying market itself. So I think those are the kind of risks that I worry more about rather than just change in volatility for underlying stocks on the expiry date.
How do you see this thing turning out? Because you spoke about the gamification of the equities market. People are now taking it as a game, and the average age of people who are now coming in around 29, it's the same as the average age of people who are going into fantasy games and others. So, it's turning out to be more of a high risk fantasy game, because you mentioned in your report that at least in fantasy game you get 85% of your money back. Here at least you lose 85% or you get only 10 to 15%.
Yes. So that is actually certainly true, and I think it is unfortunate that people who are coming into the market, getting their first taste of investments at this age, are experiencing through the F&O market because the experience is unlikely to be good, right? There is a SEBI report that came out earlier this year, which also highlights that 90% of retail F&O traders actually lose money. Right. So I think this is certainly not welcome that people who are starting their investing journey start with these products, which kind of leaves them with a bad experience. And I think the worst fallout would be that their psyche is scarred for times to come, and they can't go on and get to their financial goals through investing in more suitable or optimal products.
While investors like yours, come into derivative market for hedging and hedging your portfolio, how do you see the fact that the weekly options have now led to your premiums getting at a fraction of what it was for longer options, maybe a month or 2 month or 3 5 month option. How do you see that? Because that's creating, you are taking the same kind of exposure with respect to amount, but you're
Yes.
paying much lesser there.
Yes. Yeah, so clearly most of the people who are now active in the market are not doing this for hedging purposes, right? This is visible both by the fact that the disconnect with the cash market is huge. It is also indicated by the fact that less than 1% of these options contracts are carried forward to the next day, right? So most people, 99% people squeeze it off on the same day itself, right? So there is no real hedging that is happening. It is just speculation that is happening on the move in the index. Unfortunately, as there have been more kind of products made available as we have gone from monthly to weekly and now to daily options. The option price is a function primarily of the time period, right? So that time period has come down. The price of a option has come down. So if we take the minimum contract size of a Nifty option, broadly, monthly the option will cost you 20,000 rupee, but a daily option will cost you only about 1,500 to 2,000 rupees. Right. So I think this falling ticket size is something that has kind of triggered this gamification, and more and more people coming into and making these bets. I don't think it provides any real improvement in liquidity for institutional investors or any of the market participants who are looking to hedge their risk, because all of this is very, very short dated.
While we all want this market to grow, but it's not. It doesn't seem to be homogeneous in that sense, because it's it's there's no risk. Mitigation which has been taken care of, especially for the retail investors, given the fact that we've seen the new additions of retail investors are coming from tier 2 and tier 3 cities, where the education about FNO or derivatives market and the risk associated with is not been fully provided to those investors. So what do you think should be done to manage this kind of risk?
So I think the regulator has been aware of this. It has taken several steps towards it. It has been asking intermediaries, including all the new generation online trading apps, to put disclaimers at the login page, etc. But to my mind, the easiest way to control this is to increase the minimum ticket size. Right. I think the explosion in volumes has happened simultaneously as the ticket size of the options contract has come down with the reduction in its tenure. And I think if we make sure the minimum ticket size of the investment goes up to 15,000-20,000 rupees, you will see a significant correction in the volume. So I think while the regulator fixes the minimum lot size, and the minimum lot size, as I mentioned, for the Nifty option is almost 10 lakh rupees. So that's not a small amount, but because now you can have a daily expiry on it, the minimum ticket size of the investment has come down. So I think the best way to control it is to ensure that the minimum ticket size of investment is high enough, so that more aware investors are able to come into the market.
What you're suggesting is that you should have a higher lot size for a shorter option as compared to a long tenure option, so that the minimum ticket size goes up, because at the end the premium is been decided by the Black-Scholes formula. So you increase the lot size for small duration ones and keep longer duration at a lower lot size. Is that possible? I mean, in the sense, how will the market take it actually? Because in the absence of this, you have the government which comes in and puts in STT, which increases the cost of transaction and your profitability on it. So is that possible to have a higher lot size for short duration options, or because 50% of the volumes are now coming from what, expiry options?
Yes. Yeah, so I think it's certainly possible, and it will, of course, mean that the volume in the options market come down, but that is our desired objective, right? So it is only because we feel that the growth in this market is getting disconnected from the underlying market. There is excessive speculation we want to curb. So some of these sort of measures should be looked at.
Do you think this would be enough to cool this market a bit? And the amount of new investors who are coming through apps and easy apps, basically, right? Today, earlier KYC used to take a lot of time. Today, on a click of a button or on through an app, you can easily do a KYC and enter into the market. So, is this the measure only required, or there could be other measures that also requires like a higher risk weighted, uh, margin or anything of that sort, if it's especially for zero expiry day?
So potentially yes, but I think even if you increase the margin, if the ticket size or the is only 1,000, 1,500 rupees, you attract lot of small investors, right? And what is happening is that literally the return seems almost lottery-like, because imagine you are taking a bet on the notional value of Nifty of 10 lakh rupees with only 1,500 or 2,000 rupees. So, in a sense, you have a leverage of 500 times, right?
Okay. So that leverage is enough. How do we reduce the leverage amount? You're saying that increasing the lot size.
So basically, by spending 2,000 rupees, you are taking an exposure of 10 lakh rupees.
Yeah.
Right. So I think you need to reduce this notional leverage by making sure that the ticket size goes up.
As an intermediary, Ashish, how do you look at the entire regulatory scenario for a derivative market? Because we have exchanges who are going to come up with more products which are short duration, because they think now that this is the new fantasy game in the stock market. Earlier you used to have one expiry in a week. Now you have expiry every day. So every day there's a fantasy game, and every day there is a loss which is coming in. So how does exchange react to such a thing? Because of course they need to expand their products and their offerings, but at the same time, ensure that this has not been misused in any way.
Yes, and I think all intermediaries, whether they are exchanges, whether they are funds, whether it is even the broking companies, all are looking to build long-term businesses, and for that they will be encouraging responsible investing, right? So I think while they want to introduce new products and ensure that there is a wider array of products available to investors, there is a large amount of liquidity available in each of these product lines, but they would also want investors to have a gainful experience of investing, and that's the only way you will have long-term growth in capital markets and all our businesses. So I don't think from that perspective any of the intermediaries will be averse to these moves. As I mentioned, so if you log into any of these trading apps, the login page itself carries the disclaimer and warnings about the risk to F&O trading.
But does it help? It's just like a warning on a cigarette packet, right? You still go ahead and smoke.
Yes, right. But I think that's what the government had done, right? It's made sure that cigarettes are expensive and more expensive. I think that's what's needed here as well.
Fair enough, Ashish. It was a good pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Okay, thank you.
Thank you.